Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host, Algobot, and today we're exploring an expert advisor called Instantaneous Trendline Cross. This strategy is built on John Ehlers Instantaneous Trendline, a near-zero lag smoother of price, paired with its companion trigger line. Together, they aim to time with trend reentries while filtering out choppy, sideways noise. Over the next several minutes, you'll learn how the indicator works, how the entry and exit rules are coded, and how a sample long and short trade might play out. Remember, this is educational content only. So what exactly does the Instantaneous Trendline Cross Expert Advisor do? At its core, this is a trend-following system that reads the smooth direction of the market and waits for a low-lag turn in that direction before considering a trade. It's designed to run on a single time frame, meaning it works on whatever chart period you attach it to, whether that's the 15-minute, the 1 hour, or the daily. It can be applied to any symbol your broker offers, though traders often study it on major foreign exchange pairs such as Euro versus US dollar. The engine behind the strategy is John Ehlers Instantaneous Trendline, often shortened to iTrend. This is a recursive smoother of the median price, the average of each candle's high and low. What makes it special is that it removes much of the lag that ordinary moving averages suffer from, so it tracks the market's direction more closely and with less delay. Alongside it sits the trigger line, which is a 2-bar projection of the trend line. Because the trigger leads the trend line slightly, the moment the two cross tells you the exact bar where the smooth path has turned. Rather than trading every single crossover, which would be prone to whipsaws in flat markets, this approach adds a regime filter. It measures the slope of the trend line over a set number of bars and compares it to the average true range, a common measure of volatility. Only when the trend line is already sloping firmly in one direction does the strategy trust a crossover. In an upsloping trend line, a fresh upward cross is treated as a pullback that has returned higher. In a downsloping trend line, a downward cross is treated the same way to the downside. This makes the Instantaneous Trendline Cross best suited to traders who are curious about cycle-based, low-lag indicators and who prefer a structured, rules-based approach with clearly defined risk. Every trade carries a fixed stop and a defined profit target. As always, this is for educational purposes only and not financial advice. Let's walk through the mechanics step by step. The expert advisor works on completed candles only. Each time a new bar opens, it takes the bar that just finished, calculates its median price, and rolls the instantaneous trend line forward by one step using Ehlers' recursive formula. The smoothing behavior is controlled by a parameter called alpha, which defaults to 0.07. A smaller alpha produces a smoother, slower line, while a larger value makes it more responsive. Once the trend line has enough history to be stable, the strategy calculates two things on every closed bar. First, the current value of the trend line and its value 1 bar ago. Second, the trigger line, which is simply twice the trend line minus its value 2 bars back, again for the current bar and the previous one. From these it checks for a crossover. A cross-up occurs when the trigger was at or below the trend line on the prior bar and has moved above it on the current bar. A cross-down is the mirror image, where the trigger was at or above the trend line and has dropped below it. A crossover alone is not enough. The strategy then applies its regime gate. It measures the slope of the trend line over the number of bars set by slope bars, which defaults to 5. It compares that slope to the average true range, calculated over the ATR period window of 14 bars. The slope must be at least MinSlopeAtrFrac of the ATR, a default of 1/10, before a signal is accepted. If the trend line is sloping up firmly and the trigger crosses above it, the EA signals along. If the trend line is sloping down firmly and the trigger crosses below, the EA signals a short. Risk is handled symmetrically. When a trade opens, the stop loss is placed a distance of ATR stop multiple times the ATR away from entry, with a default multiplier of 2. The take profit is set as a reward-to-risk multiple of that stop distance, governed by RewardRiskRatio, which defaults to 1.5. So if the stop sits 2 ATR away, the target sits 3 ATR away in the favorable direction. The EA also allows only one open position at a time per magic number, so it never stacks trades on top of each other. Position size is fixed by the lots parameter. Every one of these numbers can be adjusted and tested, and remember, this is educational information, not a recommendation. Now let's look at the actual MetaTrader 5 code that makes this happen, shown here as it appears in MetaEditor. At the top are the input parameters. Alpha controls the trend line smoothing. Slope bars sets how many bars the slope is measured over. MinSlopeAtrFrac is the fraction of ATR the slope must exceed. ATR period defines the volatility window. ATR stop multiple scales the stop distance, and RewardRiskRatio sets the profit target as a multiple of that stop. Lots is the trade volume. In the middle, you can see the heart of the logic. The trigger for the current and previous bar is computed as 2 times the trendline minus its value 2 bars ago. The Boolean cross-up is true when the trigger was at or below the trend line and has now moved above it. The Boolean cross-down is the reverse. Then the slope is measured as the trend line now minus its value slope bars ago, and min-slope is the ATR times the minimum fraction. The buy block runs when cross-up is true and the slope is greater than or equal to min-slope, confirming an upsloping trend line. It reads the ask price, sets the stop-loss 1 risk distance below entry, sets the take profit at the reward-to-risk multiple above entry, and calls trade.buy. The sell block is the exact mirror. It runs when cross-down is true and the slope is at or below the negative minimum. It reads the bid price, places the stop 1 risk distance above entry, the target the reward multiple below, and calls trade.sell. Both sides share the same balanced risk structure, just pointed in opposite directions. This is educational only, not financial advice. Let's bring it all together on this illustrative chart. On the price candles, you can see 2 overlaid lines. The smoother of the 2 is the instantaneous trend line, and the slightly faster one that weaves around it is the trigger. Watch how the trigger leads, dipping and rising just ahead of the trend line. There is no separate oscillator panel here because this is a pure price overlay strategy. Everything happens right on the candles. Look at the opening candles on the left. Price is drifting gently higher, and the instantaneous trend line is sloping upward beneath it. This rising slope is exactly what the regime gate is looking for. The trend line is telling us the smooth direction of the market is up, and it is sloping by more than our minimum fraction of the average true range. So the strategy is now willing to trust an upward crossover. Then comes a small pause. On the second and third candles, the market pulls back slightly, and you can see the trigger line dip down and touch the trend line, even slipping just beneath it. This is the pullback the strategy waits for. On the next candle, price turns back up, and the trigger crosses cleanly above the instantaneous trend line. Because the trend line is still sloping firmly upward, this fresh cross-up is accepted, and the buy entry marker appears. Notice the logic here. We are not buying a random dip. We are buying a low lag turn back in the direction the trend line was already pointing. The moment that trade opens, the stop loss is placed a set distance below entry, 2 times the ATR, and the take profit is placed at 1.5 times that distance above entry. From there, follow the candles. The market pushes higher, candle after candle, the trigger staying above the trend line the entire way. The trend line itself curls upward, confirming the move. A few bars later, price reaches the take profit target marker, and the long trade closes for a gain in this illustration. The reward was 1.5 times the amount that was at risk. Now watch the character of the market change near the top. Price makes one more high, then stalls. The instantaneous trend line begins to flatten and roll over, and its slope turns downward. This is the regime gate flipping to the short side. The smooth direction is no longer up. On the very next candle, the trigger line, which had been riding above the trend line, cuts down through it. That is our cross down, and because the trend line is now sloping downward by more than the minimum fraction of ATR, the sell entry marker appears. Again, the timing is deliberate. We are entering short at the exact bar the low lag trigger confirms the smooth path has turned lower, while the regime filter agrees. As soon as the short opens, the stop loss sits a set distance above entry, and the take profit sits below at that same 1.5 reward-to-risk ratio. Follow the candles down. Price steps lower, bar by bar, the trigger holding below the trend line, and the trend line sloping down to confirm. A handful of candles later, price reaches the lower take profit target, and the short trade closes in this example. Step back and notice the rhythm. In both trades, the same three things had to line up. First, the instantaneous trend line had to be sloping firmly, defining the regime. Second, the trigger had to cross the trend line in that same direction, timing the entry with very little lag. Third, risk was always defined in advance by the ATR stop and the reward-to-risk target. The trend line sets the context, the crossover sets the timing, and the volatility-based stop sets the risk. Of course, not every signal in real markets behaves this cleanly, and losses do occur. This walkthrough is a simplified illustration for educational purposes only. That brings us to the end of our deep dive into the Instantaneous Trendline Cross Expert Advisor. We covered how John Ehlers near-zero-lag Instantaneous Trendline and its leading trigger line combine, how the slope-based regime gate filters out choppy conditions, how the buy and sell rules are coded in MetaTrader 5, and how a sample long and short trade might unfold with clearly defined stops and targets. If you found this breakdown helpful, please give the video a like, leave a comment with any strategy you'd like us to analyze next, and subscribe so you don't miss future MT5 strategy breakdowns. You can find more educational content and tools over at www.algobot.live. And remember, everything here is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Trade responsibly.